What happens if we have maybe a child that doesn't want to be involved in the farm or the ranch operation? What are our options for them?
Yeah, so I mean, many times there can be that child that just doesn't have that desire to be a part of the family farm or ranch. They really just don't have that interest. And in certain situations like that, what we take a look at are there other assets that we can use to help equalize or make things fair with that non-active child? And at times, maybe that's looking at, okay, do we want to leave the 401k or qualified retirement plan for that child and get more farm assets over to the active child? A lot of times we can use life insurance, and life insurance is a great tool because it's a tax-free asset. So what a lot of our family farm or ranches, they'll see that pool of money that's sitting in that 401k or IRA account, but they got to remember that that is a taxable asset. It's taxable both on the federal and state level. So that child may only net, 70 cents on the dollar of that asset. So if they're trying to make things fair or quote unquote as equal as mom and dad want it, a life insurance is a great tool to do that because it's a tax-free bucket of money that they can leave that inactive farm child. Okay. And a lot of times we do that with what's called a second to die life insurance policy because we're insuring both mom and dad's life. And it's a lot less expensive to insure two lives than it is just one life. And that might be the right case design. It might be the right tool in the toolbox for that situation, but it creates a pool of money that they can leave that non-active child that really doesn't have that emotional attachment to the family farm or ranch and treat them fairly. And the positive of that is we create more working capital and cash flow for the active farm child, getting them more of the farm assets and not forcing them to buy an inactive sibling out that doesn't want to be actively involved.
So let's talk about life insurance here for a little bit.
Okay.
Let's talk about policy ownership and if it was parents using it as an equalization tool, you talked a little bit about who's the insured, but who's the owner of the policy and who would be the beneficiary of the policy?
Jessica, that's a great question because through all my travels, what I run across is situations where that ownership is not structured correctly. They may say, okay, well, we want to treat little Johnny or little Susie fairly, so we're going to make them the beneficiaries. Mom and dad are going to be the insureds, but we're going to have the active farm son or daughter be the owner. Okay, we'll have the farm make the premium payments, but we're making the active farm son or daughter the owner. And the unfortunate part about that, not working with an expert again, is now all of a sudden that active farm child is making a gift from them to their siblings. And that gift could be taxable, or they have to use a portion of their unified exemption credit, and they can't use that exemption credit for their families. So they could be creating a tax adverse situation just by naming the wrong owner and the wrong beneficiary on the policy itself. Okay, so again, when you're working with those experts, working with somebody who can structure the ownership, structure the beneficiaries of those life insurance policies correctly, it becomes very important to make sure that that asset remains tax-free and that cash liquidity is there for how the family intended it.